What's up, and welcome everyone to another episode of Wolfe Street. For those of you that don't know, my name is Wolfe, and for those of you that do, thanks for checking me out again. Like always, you can check me out on all social media platforms at EveryTimeICash. That's at EveryTimeICash on all social media platforms. This video and all my videos are for informational, educational, and entertainment purposes only. Please, if you're looking for financial advice, don't get it from a guy who pretty much lives on the West Coast and just kind of gives you his opinion on the internet. Go talk to a financial advisor, figure it out, build a plan, get your life together. Don't divorce your wife because you listen to some dude on the internet. This video is going to be on the eve of, quote unquote, the most highly anticipated Federal Reserve open market meeting decision year to date, right? It's a mouthful. I'm trying to make it as exciting as possible. But long story short, we're on the eve of the Fed's decision. We got a lot of tumult going on right now. We got Ukraine, Russia, we got China, we have sanctions, we've got inflation, we've got everything, right? And so with all that in mind, this is going to be a very anticipated federal open market meeting decision. And so I'm going to give you my opinions, right? We're going to go over what I think, what to look for, what are some of the thoughts, and how to play it potentially moving forward. So without taking up any more of your time, let's just jump right into it. So the biggest question going into the FOMC tomorrow is, will they raise by 50 basis points? So will they raise interest rates by 0.5%? That's the glaring question that everyone is dying to know the answer to. And so the short answer to that is no one really knows. Jerome Powell just, I think last week, was on record telling people that it's going to be a quarter point, right? And some people assumed that that was his way of just kind of tempering people's expectations in front of Congress and setting a low bar, but in reality that he'll walk it back. I don't happen to be in that camp. I happen to believe that when he tells you that it's going to be a quarter point, it's going to be a quarter point. I happen to believe that it may have been a part of another plan that he had, which is, to kind of quell any sort of dissension that might have happened with his, fellow bankers. But at the end of the day, no one really knows, right? And so inflation being where it's at kind of gives the Fed a situation where they have to act. And we'll get to that a little bit later. But essentially, the primary question is, and if you went back a month ago, there was a 90% certainty that it will be at least 50 basis points, when it's just crazy to think because now we're basically at 7% that it'll actually happen, which is basically zero. So let's just kind of walk through this and talk about some of the things that they're potentially facing and what's some of the roadblocks that are kind of holding them up for this 50 basis point move. First things first is energy prices, right? So we talked about inflation very briefly. In my last video, I kind of covered this a little bit more. You might recognize the slide. But essentially, inflation is a big deal, and it's primarily being felt on the back of rising energy input costs, and essentially the Russia-Ukraine fiasco kind of threw a wrench into anybody's summer driving season anticipation. So the primary thing here on the back of the Fed is that they have a dual mandate, right? And their dual mandate is that they want to keep inflation low. They've often said 2%. Who knows if they'll get it down there. And they've said that they wanted to have full employment. Never mind the typo here, G full. It's just full employment. So however they define full employment is the actual way that we have to look at it, right? And so with these two bullet points being what it is that the Fed wants to actually accomplish, we know on both fronts, on the employment side, that we're getting close to full employment. We're getting back to labor market participation being back at levels that we saw close to the end of 2019, which is where we were basically at full employment and the economy was basically humming along. Basically, is what the narrative is, right? And so, with that being the case, and with inflation being rampant, they're kind of in a situation where they cannot be complacent, right? So they want to get inflation down, and they want to get people to work, and as you get to these points where you need to act in order to keep those dual mandates intact, you're faced with a limited set of variables and a limited set of tools that you can actually act with. The main sticking point here has been gas prices. So gas prices were a major issue to the consumer. I think they're starting to account for like 10% of some consumers' costs, which is a big deal. Gas prices are also a big deal on the inflation side because they affect everything from transportation to the price of your food at the grocery store, to the price of your clothing, to everything for the most part, right? Everything kind of runs on the back of oil prices and on the back of things getting shipped. And so one thing that we learned from COVID is that the Fed kind of takes into consideration the working class and the lower working class when they think of their policies and when they think of the actions that they could take. And so when you see gas prices being this much of an impact for some of these working class and some of these individuals that are struggling to get by and they just came out of a pandemic, and you go from one thing to the next, that's going to be something on the back of the Fed's mind, and it's going to be something that they probably keep in consideration when they're trying to think, what's the next move, what's the next course, what's the next thing that we're going to do, right? And so with that, it's very safe to say that the Fed's kind of boxed in, right? So inflation is high enough and employment is low enough that they can't alter their course. The economy has been transitioning. I've said this before. You probably recognize the language on this one from a previous video, but the economy has been transitioning from the buying stuff to doing stuff economy. So we've been locked in our houses for 2 years, where we bought everything. We got all our iPads, all our computers, everything, and we couldn't really go anywhere. And now things are supposed to open back up, and people are really, really juiced and really, really amped to just get out there and take that trip and take the kids out and do whatever, right? And so when these instances happen and the Fed's kind of boxed in like this, they kind of can't change course, right? And one other wrench that kind of gets thrown in, we talked about the Russia-Ukraine fiasco kind of impacted gas prices and oil prices. But one other fiasco that they've got to take into consideration now is that, unlike us, China locks down their entire economy and their entire country in some instances, but their entire jurisdictions whenever they have a COVID outbreak. And this is an issue for the Fed because no matter how much we want to be self-sufficient, self-reliant, you cannot be if you are still facing some, log jams in the system and some locks to the supply chain anytime China steps in. So with the Russia-Ukraine war and with a potential start-stop China lockdown on the back of COVID, the Fed really runs the risk of us seeing stagflation, which is basically like rot. So this is not something that the Fed wants to find themselves in, because if you let it get to that point, you get to a situation where there could be a potential instance where the economy doesn't really get back on track like they wanted. So that's one side of the barbell. The other side of the barbell is, if you have these supply chain disruptions and you continue to have them, and you continue to have Russia, Ukraine, and you continue to have all this stuff, you run the risk of inflation just really ramping, and you start having these instances of like localized hyperinflation in some respects. I mean, I'm not saying that hyperinflation unanimously and across the board, but you run these instances where they basically get so far behind things that things just kind of become a runaway train. So inflation becomes a runaway train, and things are already expensive, and now there's other stresses and other issues in the system. So now that we've talked all these situations out, it's important to say a couple things about it. One, there's an underlying current that the Fed has the markets back, and they've always had the markets back, and they'll always have the markets back, right? And this has been a current on FinTwit, it's a current on CNBC, it's a current. It's like people have the assumption that the Fed will have their back. That being said, when asked by Congress, Jerome Powell very explicitly said that if the Fed has to induce a recession, they're in order to save the economy and to get inflation under control, which sounds kind of weird, right? Like you want to induce a recession to save the economy. So essentially the best way to say that is you want to lose the battle so that you can win the war, right? So if your goal is to save the the U.S. economy and the U.S. consumer and all that in the long run, you might lose an intermediate or short-term war or a short-term battle in order to save that instance, right? That's one. The other thing is he referenced that they did do that, and referenced Volcker in particular, that they did do that in the past, and it's something that though they would rather not do, it's something that they would potentially do. Now, also, on the other extreme, early in the year, people had these expectations that the Fed was going to raise 7, 8, 9, 10, 12 times, right? I think it's safe to say that we're in a situation right now where that probably doesn't happen. I think there's too much uncertainty outside in the world and outside of us in the United States to kind of assume that something like that would happen. There's also an assumption that the Fed might not act, right? So there's that assumption that the Fed might just say, hey, you know what? Things are really bad. Now's not the time. Now, I happen to reside in the camp that says that if the Fed doesn't act, if they don't, raise by that quarter point, and at the end of the day, what's a quarter point? A quarter point's not really anything, right? But if they don't raise a quarter point, I'm of the belief that the Fed's inaction will actually kind of spook the markets. And so why do I think that? The reason being, if the Fed does not raise and everybody knows inflation's out of hand and everybody knows there's issues and the Fed's told people that they're going to raise by a quarter point, if they don't raise, it could potentially signal an issue to investors and to participants or whatever you want to call them, that like, what is it that they know that we don't know? How bad is it? And so I think they're in a situation right now where they have to at least try to save a little bit of face here, right? Not spook the market and thread the needle a little bit. I think the best course of action that people could look for is that they raise by a quarter point today or tomorrow, and I'm sure you'll be seeing this the same day that they raise, but that they raise by a quarter point, they stay the course, they say they're going to stay data dependent, they're going to monitor the COVID lockdowns and see if it creates any more disruptions to supply chain. They're going to monitor Russia, Ukraine to see if it creates any further inflation situations. They're going to use all their tools in their toolbox, yada, yada, yada. Now, the other thing that I think is there's a potential that the Fed raises by a quarter point, talks sweetly to the market, says what they need to say, kind of keeps this borderline hawkish, borderline dovish stance. But in May, finds himself in a situation where they have to raise more aggressive than people might be looking out for. So my 2 cents would be that they potentially raise by a quarter point now, and come May, they raise by half a point. And, call me crazy, but that's my opinion. And then the other thing is, on the back of all of this, at the end of the day, a quarter point's a quarter point. As long as they don't say anything that spooks the market, they'll find themselves in a situation where they made the right instance or right decision for market participants in general. So with all that said, that was like a mouthful, and that was like a lot to throw at you. It's important to talk about sentiment going into these things. So in general, people have been wildly negative the last couple of weeks, and people have been in situations where they're calling for continued sell-offs. It's the end of the world, World War III, yada yada yada. And that could be the case. So I'm not going to be here. I'm not going to be the guy that comes out here and says that he's optimistic, because I'm not generally an optimistic person. I'm kind of like a pessimist when it comes to society. I think people in general are selfish, right? And so I'm not going to be Mr. Optimism here. I'm not going to be the guy that tells you that things are going to be perfect and they're going to do everything perfectly and they're going to thread the needle. No, I think at some point the Fed's going to fuck up, and I think at some point, and we might already be at that point. I actually do think that they're behind the eight ball here. They're behind the curve. I do think they have to act. And at the end of the day, I think they're in a situation where they believe that they could let inflation get a little bit hot as long as they don't cause a recession. And so I think even though they might be in a situation where they would cause a recession, and wouldn't hesitate to cause one in order to save inflation from becoming a runaway train, I do think they're in a situation where nobody wants to be the bad guy and actually induce the recession, right? I just think of it like a situation where you got a loved one on life support and you've got to pull the plug. You'd rather not pull the plug early, hopefully. And so in situations like that, I think the Fed sees things that way. So I say all this because everybody's negative sentiment. Everyone's been negative, negative, negative. And there might be an instance where you see a potential relief rally on the back of the Fed if they did thread the needle, right? And so that's something to keep in mind and something to keep in the back of your head. And it's also important to know like some of the levels, right? So this is from the 15th of March. This is a table of different levels that I watch in the S&P. This is relative to prior day. So this is relative to the 14th, right? And so you can screen cap this. I can share it if you need it. Just ask for it, whatever. But essentially, what you want to do on days for the Fed or any major move day, you want to have a table of some kind. You want to have your different levels for the overall market laid out so that you can kind of go through them and kind of understand where your potential downside is, where your potential upside is, et cetera, et cetera. So I'm keeping this here as a reference point for now, and then I'm going to roll over to look at different levels on the charts and kind of talk it out with you, right? And so up here you have, resistance 1, 2, 3, support 1, 2, 3. And so every morning I have one of these and I have it up on my screen throughout the day while I trade. And I think it's a really good habit to have. It's a really good thing to keep on your screen. And it's a really good tracking mechanism to kind of see where you are and where things could go. Okay, so now let's just put this to practice, right? So this is I like to use the Nasdaq as reference because that's predominantly what I trade. There are other tools that you can look at, but predominantly I like to trade in Nasdaq and Nasdaq stocks. The top 10 stocks account for 30% of the market. A lot of those stocks are tech stocks, so I think this is a really good barometer. Essentially, you've had the Nasdaq. There was a head and shoulders here at some point. Just bear with me. There was one here, and then we broke down. And then there's also this, falling wedge, falling triangle, whatever you want to call it, right? The Nasdaq in general saved at 12,971. This is the E-mini futures contract, not the Nasdaq overall, but essentially it was saved at 12,970. And then on the back of that stick save today, we had a rally pretty much most of the day. There was a brief moment where it kind of dipped off midday. Now, there's been a lot of talk in the last couple of days on Twitter, on social media, on all that stuff about a death cross in the S&P, a death cross. Let's see if I can pull it up. That there's a death cross forming in the S&P, and that's generally a bad thing, right? And so that's been a topic of conversation that I've seen, I've heard, whatever. It's really important to note where these death crosses happen and where sentiment is leading into these situations. And it's really important to note this because if you go back to March of 2020, when you last had a death cross like that, the S&P actually rallied. In March of 2020, you had a death cross, I think 7 days after you had the absolute low in the market. And on the back of this, quote unquote death cross, the market actually broke out, and we never went back and retested the lows. So yeah, the last time we had a death cross was March 31st, 2020. That was approximately 6 days after the COVID low on March 23rd. When it triggered, buyers stepped in to the extended downside, and we never retested. So we can go back and we can look at it specifically. And that was March 31st. Oh, nope, don't want to leave. That was March 31st of 2020. So let's go here. All right, so we have March 31st, 2020. That would be right here. And so your death cross happened here. And as you can see, we had one day where it went down, April 1st. And April Fool's it was. We've been up and away ever since. So it's really important to note when these instances happen. And it's important to know that, even though that they may happen, you might see these technical indicators where you have death crosses in situations like this, that you have to monitor what the sentiment is around it. And so I say that because if you just take a look at your screen right now, there have been a really, really aggressive bearish sentiment spikes with these death crosses, right? And so one thing you don't want to do is you don't want to potentially really press your bets into overly aggressive over aggressive direction, whether it be upside or downside, unless you've got some sort of exogenous event that could justify it. So when you've got these extreme sentiment shifts in this case, bearish, and if you have these situations and there is no like exogenous event to justify it, you could be pressing your bet at the absolute worst time, especially if you have volatility elevated, because it's going to cost you more to play, right? And so I'm sharing this because I find it valuable, and I find it an instance where you of having to take the totality of the picture rather than just say, oh, death cross, time to short, bearish, whatever. And so let's just jump back into the S&P. So the S&P, essentially, you've got this, channel that it lives in now, and it on a downtrend. We could just go ahead and delete this trend that didn't really hold for now. Let's just go with that. The S&P has been finding sellers every time it gets to this 20-day. Let's just highlight, Control CV. So you're getting sellers pretty much anytime it gets to this 20-day. And so assume that we can get to this 20-day again, and the Fed doesn't say anything that we like. You might have a situation where the S&P kind of rolls back over, right? Now, if we are in a situation where it doesn't roll over and it actually breaks out, the 50-day and the 150-day are significantly higher than the 20-day. And so I say this to you, and I gave you the backdrop telling you that the bearish sentiment has been elevated and people are predominantly negative. There's no real reason to be positive. I was in several spaces in the last couple of days. Like everybody and their brother is saying, hey, the war's still going to happen. The Fed's going to raise, blah, 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 right? And so, yeah, that all these things matter. I'm not saying they don't matter. I'm not saying that they don't have any weight. But there could be an instance where the Fed actually kind of does thread the needle a little bit, and you see a little bit of a relief rally because, people look at, that event as like, oh, okay, I ripped the Band-Aid off, I got it out of the way, et cetera, right? And so when I think of this, and when you think of this, and when you plot it out, when you look at it, In this instance, same thing, right? And already now we've seen Nasdaq futures are rallying even as I talk. So yeah, even as I talk, they've gone a little bit parabolic, right? And so, you know, um, in general, you'll have a nice little runway again to that 20-day, which has also kind of been resistance along the way ever since it broke down in early January. So generally, the market's been rallying to the 20, rallying to the 20, rallying to the 20, and then who knows what happens here, right? And again, if we break out of this downtrend, if we break out of this falling wedge, whatever term you want to use, if you break out of this 13,830 level, call it, you possibly have a runway to 14,400, which is where that 50-day moving average will end up. There could be an instance where we have a relief rally there until we then go the following week and everybody starts thinking, okay, well, what's the Fed going to do again, right? Or what's China going to do? Or what are the sanctions going to be like? Or what's happening, right? And so now that we've covered those two, I'm just going to throw up the IWM real quick. This one's a little bit weaker than the bunch. In general, that will be the case. You'll have it be stronger when the economy's stronger. You'll have it be weaker when the economy's weaker in general. But I don't like to trade this one personally. I do think that the Russell 3000 is a good indicator. I put a chart of this one up the other day. Give me 1 second. Let me see where it is. Russell 2000. Yeah, I do think that the Russell 3000 is a good indicator. Russell 3000 tagged basically support. The Russell 3000 is a basket of the S&P 500 and 2,500 other stocks, and it's basically like a general aggregate of the market. It's a very good tell. It's like a very good balanced look. And there could be an instance here where we have a little bit of a stick save and a little bit of a rally. And again, could bounce here a little bit. And there's a 20-day again, and you could get a situation where you rally, come back to the 200-day, and then buyers kind of get absorbed in this. Let me just draw this out. Buyers kind of get absorbed here in this sell zone, basically. And so you could have an instance where that happens, and then you see some rollover. Apple is an important one to watch. It broke its 200-day yesterday for like literally a day. Came close to this uptrend that it's been in since July of 2020. Came close, didn't tag it, but came close. And then now, again, same thing, has an opportunity to possibly break through this 5-day up to the 20. And again, this thing could run from, where we're at 155 all the way to like 170 and still be stuck in a downtrend. So it's really important to keep these perspectives, and really important to know that just because something says death cross, and just because sentiment's really shitty, and just because the Fed might raise, doesn't mean that there couldn't be a relief rally, right? And again, I'm saying all this, I'm prefacing all of this, and I'm saying that doesn't mean that could be the case. But for all we know, Fed can come out tomorrow and say, hey, we were raising by 50, and things are more dire than we thought, and then everything goes to hell. So in that instance, let's just map that out and think of things from that perspective. So in that instance, you'd have a situation where Fed says something negative, ostensibly this 12,970 level breaks. Then what you want to do is you want to map out prior highs, you want to map out prior levels. So looking at 12,400 to 12,450 basically as support, or excuse me, 12,350 as support. And so that's kind of like how you'd map it out. Individual names, again, I just did Apple. We'll do Amazon real quick. Amazon's been a tough one. It gets to this 2750, 2760 level, finds buyers, snaps back, fails the 50, right? And so it's been failing the 20 lately. If it could get through, you're looking at the 50-day. That's been resistance. If somehow it can get through it, you'd have this runway back to this breakdown level, which is where it broke down again. Previously, Microsoft, same kind of concept. Comes down, finds support at this 272 level, and then finds resistance at the 20, 200-day. But in this instance, again, it's important to understand the distance between the 20-day and the 200-day. So again, there could be an instance where you see Microsoft on the back of a relief rally, rally to this 200 day and stall out. This is not a crazy. It's not a crazy thought here, right? Like $13 for a $287 stock is not absurd. And so, last couple, we'll do Google. Google's again finds support at this 2500, 2490 level, and same kind of concept. 20-day sell, 100. Is this 150? Yeah, 150-day sell. So again, now you have this 20-day, you have the 150-day. There's a quite a disparity between the two here again, and so sure, you could see like a little bit of a relief rally, $70, $100 relief rally, maybe more. Could get to the 200-day for all I know, right? And then possibly sell off. If not, and it sells off and it breaks, you're looking at this 2,500 level of support. Below that, you're looking at 2,450, and then below that, it's basically like, how low can they take it, and before ultimately getting to this 2250 level that functioned as support. Facebook's another example. This happened today. We isolated it in the chat in real time, but it came to the penny, it of breaking down. Right, it looked like absolute shit. We highlighted a contrarian long, and so it tended to work out. I didn't actually take the trade, but tended to work out. It rallied, and now it's at its 5-day. Same kind of concept. It hasn't actually tested its 20-day since breaking down. So this could be an instance where Facebook actually gets up there and tests that 202 level, which is basically its 20-day exponential moving average, and then that 207 level, which is its 20-day simple moving average. So that's kind of like how you want to think about it, right? So you want to be a little bit nimble, you want to be a little bit flexible, and you want to understand that just because things are not necessarily positive doesn't mean that they have to stay negative, right? There could be a little bit of neutrality here. There could be some relief here. There could be an instance where you set yourself up for another rollover at a higher level. And so, even though I just said all of this, right, I happen to believe that we're still in a rolling bear market in some of these tech names. I happen to believe that we're going to potentially break these lows that we have at 12,970 on the Nasdaq 100 E-mini. I happen to believe that the market itself will probably roll over again on the back of some other headline or on the back of some slowing growth numbers or whatever. I do believe that that's going to be the case. But with that said, in these bear market rallies and in these bear markets in general, you get these violent rallies to the upside that are superseded with a rollover and some selling again. But in the moment when these moves happen, the rallies are very violent, and so I think it's really important to keep these levels in mind and to understand these things, because you'll find yourself in a situation where you could see a stock rip 25%, like we had in the end of January. So if you just go back here, the end of January on this is Tesla, by the way. You had a low of 792 on January 28th, and then by what day is this? Well, basically by February 1st, you had the stock trading at 943. So, it doesn't look like much on the chart because of just how aggressive Tesla moved, but you're looking at, $150 in a matter of 3 days on Tesla, right? And so some of these moves are very violent and very aggressive, and they happen faster than you kind of wrap your head around them. And so it's very important to kind of keep this in the back of your mind. So I'm gonna end with Tesla, just because I get asked about this way too much. But essentially, Tesla's been in this little uptrend triangle, whatever, since November of 2020. We tested it here in May of 2020, and we tested it here in late February, and here we are again testing it now. It's barely holding on to this trend. It basically undercut it yesterday. It's at the 5-day. The distance between the 5-day and the 20/200. For the 20-day, it's about 5-6%. For the 200, it could get to basically 860. And so again, you have an instance where you have a stock trading at $800 and there's, potential to see a runway $40 to $60 higher in a blink. And if it really got aggressive, can go 10% to this 150-day and breakdown level, right? So it could get to this point if they really got aggressive. Or even, like it's Tesla, so I wouldn't put it past to getting to 920, right? So same kind of concept. You get this instance where you could see a quick, very sharp, you know, trough to peak, 100-point move in a matter of days, 120-point move in a matter of days, and still be in a, rolling bear market scenario where, these rallies that are aggressive get sold and bleed out over time. So I'm going to end it here with Tesla. I just think it's really important to kind of keep perspective and know what you're getting yourself into, and kind of understand what it is that could happen potentially and what it is that you should plan for. If you've made it out this 35 minutes, I want to say thank you for your time. Thanks for watching. Please, if you liked this video and you like the video and some of the stuff I say, please leave me a comment below, like it, share with your friends. I love the feedback I've been getting. It's helped me hone in on what to do and what not to do. So, any kind of feedbacks, I'm welcoming it, positive or negative. Do your worst. But yeah, thanks for watching. Stay nimble tomorrow and today, whatever day you watch this. So stay nimble. Make sure that you remember that the first move typically on Fed days is the fake out, and there's generally the second move on the back of this is the move that kind of sticks a little bit. And so yeah, so thanks for watching. Please stay safe, stay profitable, and as always, stay locked.